Do not let the silence fool you. Right now, the financial markets are closed. The ticker tape is stopped. The screens are black. The price of silver is frozen at $71.47. It feels peaceful. It feels like the world is taking a break for the new year. But under the surface, the pressure is building to a level we have never seen before. We are currently in the eye of the storm. Tonight, at 6 p.m. Eastern Time, the electronic futures market will reopen. And when that switch flips, the capital that has been waiting on the sidelines for the last 2 weeks is going to flood into the room all at once. We are not just starting a new trading day, we are starting a new trading year. And in the world of institutional finance, the first week of the year is the most violent, explosive, and profitable week on the calendar. It is called the January effect. It is a mechanical phenomenon where hundreds of billions of dollars of pension fund money, insurance capital, and hedge fund assets are forced to enter the market to rebalance their portfolios. And this year, they have a problem. Their models are telling them to buy the best performing asset of 2025. That asset is silver, but there is no silver for them to buy. The vaults are empty. The dealers are sold out. The miners are hoarding. So, when that $50 billion wave hits the market tonight, it is going to hit a brick wall of scarcity. In this massive market investigation, we are going to prepare you for the opening bell of 2026. We are going to explain the mechanics of the pension fund panic. We are going to show you why the banks, who smashed the price on New Year's Eve, are about to flip their strategy and chase the price higher. And we're going to give you the battle plan for the next 48 hours. The countdown has started. The money is queued up, and the price is about to move. This is the story of the January squeeze. To understand why tonight is so critical, you have to understand how the plumbing of Wall Street works. Retail investors trade based on feelings. They buy when they are excited. They sell when they are scared. Institutional investors trade based on dates. December 31st is the fiscal year end. Up until midnight last night, the game was about defense. Managers were selling winners to lock in bonuses. Banks were selling assets to lower their risk scores. Taxpayers were selling losers to harvest deductions. The entire pressure of December is selling pressure. But the moment the calendar turned to January 1st, the game changed to offense. The tax year is over. The selling pressure is gone. Now the new allocations kick in. Every major fund has a target allocation for the new year. We want to own 2% commodities. We want to own 5% gold. Right now, they own 0. So they have to go from 0 to 5%. And they have to do it fast. They usually execute these orders in the first 5 trading days of January. This creates a massive artificial wave of buying demand that has nothing to do with news and everything to do with asset allocation. It is a wall of money that hits the market like a tsunami. And this year, the tsunami is bigger than ever. Why? Because in 2025, bonds collapsed and stocks were volatile. Silver was the only thing that worked. So the model portfolios, the computer programs that tell bankers what to buy, are screaming one word: silver. They are mandated to buy. They have no choice. And they are about to try and squeeze their elephant-sized orders through the mouse hole of the silver futures market. Let's put a number on this. The global pension and endowment market manages roughly $50 trillion. Historically, they ignored commodities. But with inflation sticking above 5%, they are panicking. They are moving money out of the 60-40 stock and bond split and into alternatives. If the global pension system decides to move just 0.1% of their assets into silver, that is $50 billion, $50 billion of new buying. Now, look at the size of the silver market. The entire annual mine production of the planet is about 800 million ounces. At $71, that is worth roughly $56 billion. Do you see the math problem? The pension funds want to buy almost the entire annual supply of the planet in the first week of January. It doesn't fit. You cannot buy $50 billion of silver at $71 an ounce. There isn't enough metal. So what happens? The price has to act as the rationing mechanism. The price has to rise until that $50 billion buys a smaller amount of metal. If silver goes to $140, that $50 billion only buys half the annual supply. If silver goes to $280, it buys a quarter. The price has to rise to accommodate the capital. This is not speculation. This is fluid dynamics. When you pour a gallon of water into a shot glass, it overflows. Tonight, the water starts pouring. The first sign of this wave will happen tonight, Thursday, 6 p.m. New York time. The Globex electronic markets open. This is where the algorithms trade while the floor traders are sleeping. Usually, holiday sessions are quiet, but tonight is different because the Asian arbitrage is still open. Remember, while New York was closed for the holiday, Shanghai was still hungry. The gap between the US price and the China price is still there. Tonight, the arbitrage bots will turn on. They will see the gap. They will see the cheap silver in New York, and they will hit the buy button. This could create a gap up right at the open. We could see silver jump from $71.47 to $73 in the first minute of trading. If this happens, it sets the tone for Friday. It tells the human traders the dip is over, the buying has started. It creates a sense of urgency. Anyone who was waiting for lower prices will realize they missed the bottom. They will panic buy. This fear of missing out will add fuel to the fire started by the algorithms. Now, let's talk about the banks. Yesterday, we explained how the GSIB surcharge forced banks to sell silver to clean up their balance sheets for the year-end snapshot. They smashed the price to $70.50. They achieved their goal. They lowered their risk score. They saved their bonuses. But now, the snapshot is over. The regulators have taken the picture and left the room. The banks are free to trade again. And what do banks do? They trade to make money. They know the flow is coming. They know the pension funds are buying on Friday. So, do you think the banks are going to stay short? No. They are going to front-run their own clients. JP Morgan knows that the California Teachers Pension Fund is going to buy silver tomorrow. So JP Morgan buys silver tonight. They buy it at $72. And tomorrow they sell it to the teachers at $75. They scalp the market. This means the banks, the biggest sellers of 2025, will likely be the biggest buyers of the first 48 hours of 2026. They are flipping the switch. The suppressor becomes the squeezer, because they want to ride the wave up before they short it again later. This aligns all the major forces in the market. The East is buying. The pension funds are buying. The banks are buying. Who is selling? Nobody. The miners are holding. The dealers are out of stock. The retail investors are hodling. This is the recipe for a vertical move. So the paper money is lining up. But what about the metal itself? Well, while the markets were closed today, the physical shortage didn't take a holiday. The factories in China are still running. The mines in Mexico are still depleting. We have to look at the physical disconnect as we enter the new year. We are going to check the dealer premiums one last time before the open. And we are going to explain why the street price of silver is likely to cross $100 in January, regardless of what the COMEX does. The countdown is ticking. We are hours away from the first trade of 2026. If you are looking at the chart right now, you see $71.47. That number is flashing on screens in Tokyo, London, and New York. It is the number that the algorithms use to value billions of dollars of derivatives. But I have to tell you something that the bankers won't admit. That price is a lie. It is a phantom price. It is the price of a digital contract that was traded on a holiday week with thin volume. If you try to take $71.47 into the real world and exchange it for an ounce of physical silver, you will be laughed out of the room. The paper market is currently living in a fantasy land. The physical market is living in a supply crisis. We are going to expose the massive disconnect between the screen and the street. We are going to look at what happened to the bullion dealers over the last 48 hours. We are going to explain why the premiums on physical silver have exploded to historic highs, even as the spot price dipped. And we are going to show you why the industrial buyers, the companies that actually consume the metal, are already paying $80 an ounce in private deals just to secure delivery for January. The paper market is about to open, but the physical market never closed, and it is screaming shortage. Let's talk about what happened on Main Street this week. While the hedge funds were selling paper to lower their taxes, the retail public was storming the coin shops. We have received reports from major online bullion dealers in the United States and Europe. They are reporting a complete blowout of inventory. Usually, the week between Christmas and New Year is quiet. But this year, sales volume was up 300% compared to last year. Why? Because the public smells the fear. They saw the volatility, they saw the headlines about debt, they saw the crash and the recovery, and they decided to take possession. But here's the problem. The dealers cannot restock. The sovereign mints, the US Mint, the Royal Canadian Mint, are closed for the holidays. The wholesalers are running on skeleton crews. So every ounce that was bought this week is an ounce that cannot be replaced until mid-January. The shelves are bare. So what did the dealers do? Did they lower the price to match the spot market drop? No, they raised the price. If you look at the premium on a Silver Eagle right now, it is approaching $20 over spot. The ask price is over $90. This is the market telling you the truth. The spot price says silver is abundant. The premium says silver is extinct. This divergence is the most reliable signal in commodities. When the paper price drops, but the physical price rises, it means the paper market is broken. It means the shorts are suppressing a beach ball that is fighting to surface. And when the paper market finally breaks, it snaps up to meet the physical price. It doesn't meet in the middle, it gaps up. Now, let's look at the whales of the physical world, the industrial users. We talked about the January effect for pension funds, but there is also a January effect for industry. It is called procurement season. In January, companies like Samsung, Tesla, and First Solar negotiate their annual supply contracts. They sit down with the refiners and the miners to lock in their price and volume for the year. Usually, this is a boring meeting. We need 10 tons, here's the price. But this year the meeting is a panic room. The refiners are telling the industrial giants, we don't have enough metal. The mines are depleting, the Chinese are hoarding, the recycling is failing. We can only give you 70% of what you need. Imagine you are the CEO of a solar company. You have a mandate to double production in 2026, and your supplier tells you they are cutting your silver allocation by 30%. What do? You panic. You go into the spot market and you buy everything that isn't nailed down. You pay any price. $75? Fine. $80? Fine. You just need the metal to keep the factory open. This is happening right now. While the markets are closed, procurement teams are making phone calls, they are engaging in off-market transactions. They are buying silver directly from the vaults in London and Zurich. They are bypassing the COMEX. This removes the visible inventory from the exchange. When the COMEX opens tomorrow, the traders will look at the warehouse report and say, where did the silver go? It went to a solar farm in Arizona, and it is never coming back. We cannot talk about physical silver without talking about China. While New York sleeps, Shanghai eats. The price in China is still trading at a massive premium to the West. We are looking at a gap of nearly $5. While New York was sleeping, China implemented new silver export controls today, January 1st. They are locking their doors while Wall Street is still trying to find the keys. This arbitrage is the engine of the shortage. Every day that New York trades lower than Shanghai, a fleet of airplanes takes off from JFK and Heathrow carrying silver bars to the east. This is not a conspiracy, it is simple math. If you can buy an iPhone for $500 in New York and sell it for $600 in Shanghai, you buy every iPhone in New York. That is what is happening to silver bars. The West is being drained of its strategic reserve. We are selling our heritage for paper dollars, and China is happily taking it. They know that in 2026, the paper game ends. They want to be holding the physical chips when the music stops. And this flow of metal creates a floor under the price. The price cannot drop below the level where arbitrage becomes profitable. Right now, that floor is $71. If silver drops below $71, the Chinese buyers back up the truck. They act as the buyer of last resort. This limits the downside risk for you. You are investing alongside a superpower that wants to corner the market. But wait, the skeptics say. If the price is $70, the miners will just dig more. No, they won't. This is the supply cliff we discussed in our deep dive. It takes 10 years to open a new mine. Even at $100 an ounce, you cannot speed up the geology. You cannot speed up the permits. You cannot speed up the construction. In fact, supply might actually drop in 2026. Why? Because of political risk. Look at Mexico. Look at Peru. The governments there are looking at $70 silver and getting greedy. They are talking about higher taxes. They are talking about nationalization. When governments attack miners, miners stop investing. They stop digging. They go on strike. So precisely when the world needs more silver, the political environment is ensuring we get less. This is the definition of a structural deficit. It is not fixable by price alone. It requires a decade of investment and stability. We have neither. So the industrial buyer knows that no help is coming from the mines. The retail buyer knows that no help is coming from the mints. The only place to get silver is from existing stockpiles, from the vaults. The vaults are running on fumes. So the physical market is tight. The dealers are empty. The industry is panicking. But there's a bigger storm brewing on the horizon, a storm that will make the supply shortage look like a minor inconvenience. The macro economy. Now, we have to zoom out. We are going to look at the debt ceiling crisis that is scheduled to hit Washington in February. We are going to look at the bond market revolt, and we are going to explain why the Federal Reserve will be forced to print trillions of dollars in 2026 just to keep the government solvent. Silver isn't just reacting to a shortage of metal, it is reacting to a surplus of fiat currency. We are about to enter the monetary phase of the bull market, where silver stops trading like a commodity and starts trading like a currency. The physical squeeze lights the fuse. The monetary crisis is the dynamite. We are looking at the death of the dollar. We have spent the last hour looking at the microscopic details of the silver market. We counted the ounces in the vault. We tracked the planes flying to Shanghai. We analyzed the solar panels. But if you focus only on the metal, you miss the monster. Silver does not exist in a vacuum. It exists in a world drowning in $36 trillion of United States debt. It exists in a world where the bond market is rebelling against the central banks. It exists in a world where the full faith and credit of the empire is being questioned for the first time in 80 years. Now, we have to zoom out. We are going to look at the macro storm that is about to make landfall in the first quarter of 2026. I'm going to explain why the upcoming debt ceiling crisis in Washington is the trigger event that sends commodities into the stratosphere. We are going to analyze the bond vigilantes who are driving interest rates higher, forcing the Fed to print money just to keep the government solvent. And I am going to show you why silver is not just an industrial metal anymore. It is a currency lifeboat. The physical squeeze lights the fuse, but the monetary collapse provides the explosion. Let's look at the debt. While you're celebrating the new year, the politicians in Washington are preparing for a war. In February of 2026, the United States hits the debt ceiling. Again, we have seen this movie before. They fight, they threaten to default, they shut down the government, and then they raise the limit. But this time is different, because this time, the interest on the debt has exploded. The U.S. government is now paying over $1 trillion a year just in interest payments. That is more than the defense budget. That is more than Medicare. It is mathematically unsustainable. So when the debt ceiling fight starts next month, the market is going to panic. Credit rating agencies, Fitch, Moody's, will threaten to downgrade the U.S. credit rating again. Foreign nations will stop buying treasuries because they are scared of a technical default. This creates a crisis of confidence. When investors lose confidence in the risk-free asset, U.S. bonds, where do they go? They go to the assets that have no counterparty risk, gold and silver. During the last debt ceiling crisis, gold rallied. This time, with silver already in a shortage, the rally will be amplified. Silver acts as a credit default swap on the U.S. government. As the probability of government chaos rises, the price of silver rises. You're holding insurance against political incompetence, and business is booming. We need to talk about the bond market. It is the largest market in the world. It controls everything. Right now, the bond market is screaming. Yields are rising. The bond vigilantes are selling treasuries because they know inflation is not 2%. They know it is 5% or higher. Why does this matter for silver? Because higher yields break the banking system. We saw it in 2023 with Silicon Valley Bank. Banks hold bonds as collateral. When bonds crash, the banks become insolvent. If yields spike in January, we will see another banking crisis. Another regional bank will fail. Maybe a big bank will wobble. And what does the Federal Reserve do when banks fail? They pivot. They stop fighting inflation. They stop raising rates. They turn on the money printer. They create emergency liquidity facilities. They flood the system with fresh dollars to save the banks. This is the Fed put. Every time the system breaks, they print money. And every time they print money, the value of the dollar falls and the price of silver rises. We are waiting for the system to break. The bond market is doing the work for us. It is forcing the Fed into a corner where their only option is to inflate away the debt. Inflation is the fuel for the silver supercycle. While the West struggles with debt, the East is building a lifeboat. The BRICS alliance, Brazil, Russia, India, China, South Africa, and the new members, is actively moving away from the dollar. They call it de-dollarization. In 2026, we expect a major announcement regarding a BRICS trade settlement unit, a currency backed not by promises, but by hard assets, gold, oil, rare earths, and silver. China knows that to challenge the dollar, they need a currency that has intrinsic value. Paper money is a weapon used by the US. Commodity money is the shield used by the BRICS. If silver becomes a component of a global monetary reserve system, it remonetizes instantly. For 40 years, silver was just a commodity like copper. If it becomes money again, the valuation model changes. Money trades at a premium to its industrial value. Gold trades at a massive premium because it is money. Silver is currently trading at its industrial value. The monetary premium is the upside, and the BRICS nations are the ones who will apply that premium. Wall Street analysts love to talk about real interest rates. They say, if interest rates are high, gold and silver should fall because they pay no yield. This is the textbook theory. But look at the reality. Interest rates are 5%. Silver is at $75. The textbook is broken. Why? Because the market knows the interest rate is fake. The real rate is interest minus actual inflation. If the bank pays you 5%, but the cost of living goes up 10%, your real rate is negative 5%. You're losing purchasing power by holding cash. Smart money knows this. They know the CPI numbers are cooked. They know that true inflation is double digits, so gold and silver are rising with interest rates. This is a historic anomaly. It usually only happens during a currency collapse. When the market stops believing the central bank, the rules of economics invert. We are living in that inversion. Finally, let's look at the second wave of inflation. The Fed claimed victory. They said inflation was coming down, but look at the inputs. Oil is rising, shipping costs are rising. Labor costs are rising. Insurance costs are skyrocketing. Inflation is sticky. In the 1970s, inflation came in 3 waves. The first wave hit, the Fed raised rates, inflation fell, everyone celebrated. Then the second wave hit, it was bigger. Then the third wave hit, it was the biggest. We just finished wave 1. Wave 2 is building. When the inflation numbers start creeping back up in 2026, the market will realize the Fed is powerless. They cannot raise rates anymore because it would bankrupt the US government. So they have to let inflation run hot, financial repression. In a world of structural, persistent inflation, you need assets that cannot be debased. Silver is the ultimate inflation hedge because it is also an industrial necessity. It protects you from the printing press, and it benefits from the economic growth. It is the only asset that wins on both sides of the coin. So the macro storm is gathering. The debt is unpayable, the bonds are crashing, the inflation is returning, and the physical silver market is empty. What happens when you throw a match into a room filled with dynamite? You get an explosion. But analysis is useless without execution. The analysis stops, and the execution begins. We have reached the final chapter of this New Year's investigation. We have dissected the $50 billion wall of capital that is about to hit the market. We have exposed the physical dealer blackout and the industrial panic. We have analyzed the macro superstorm of debt and war. Now, the analysis stops, and the execution begins. Tonight, the electronic markets will open, and tomorrow morning, the opening bell of 2026 will ring. You have the information, you know the why, now you need the how. In this final breakdown, I'm going to give you the execution strategy for the first week of January. I'm going to map out the specific price targets we need to hit to confirm the supercycle. I am going to teach you the ratio exit, so you know when to walk away with your fortune. And I'm going to leave you with the final verdict on the year ahead. The year of potential is over. The year of realization is here. Let's finish this. Let's look at the chart one last time before the candles start moving. We are sitting at $71.47. We are resting on a massive support level. So what are the targets for the first week of January? Target 1, $75. This is the previous high. This is the breakout point. If the pension funds enter aggressively on Friday, we should clear $75 within the first 48 hours of trading. If we break $75 on high volume, it confirms that the correction is over. The green light turns on. Target 2, $83. This is the wick high from the Monday squeeze. Technically, price loves to revisit the scene of the crime. The market wants to test that level again to see if the sellers are still there. I believe we will challenge $83 before the end of January. If we clear 83, we are in blue sky. Target 3, the triple digits. This is the quarterly target. If the shortages are as real as the premiums suggest, and if the bond market volatility continues, there is no structural resistance between $83 and $100. It is a vacuum. The price could move from 80 to 100 faster than it moved from 20 to 30. So do not be surprised if we see a parabolic move in Q1. Be prepared for it. Do not sell into the first spike. Now, I need to have a serious conversation with you. Buying is easy, selling is hard. Most investors ride a bull market all the way up and then ride it all the way down. They fall in love with the asset. They become cultists. You're not a cultist. You're an investor. The goal is to increase your purchasing power. So when do you sell? You do not sell for dollars. Dollars are the problem. You sell for gold or land or income-producing assets. We use the gold to silver ratio as our GPS. Right now, the ratio is roughly 60 to 1. This is still cheap. Historically, in a bull market, the ratio compresses. The plan. When the ratio hits 40 to 1, you pay attention. The easy money has been made. When the ratio hits 30 to 1, you start to scale out. You trade 20% of your silver for gold. You are trading the high-risk asset for the no-risk asset. You're locking in the win. When the ratio hits 15 to 1, you exit completely. You swap all your silver for gold, or you buy a farm, or you buy an apartment building. You move from speculation to generational wealth preservation. If you follow this plan, you don't care about the dollar price. You don't care if silver is $500 or $5,000. You only care about its value relative to other real assets. Write this ratio down. Tape it to your computer, 15 to 1. That is the finish line. We are about to enter a mania. A mania is different from a bull market. In a bull market, people are optimistic. In a mania, people are irrational. You are going to see your friends and family, the ones who laughed at you, suddenly asking how to buy silver. You're going to see YouTube channels that talk about gaming or makeup suddenly talking about precious metals. This is the shoeshine boy indicator. When this happens, you will feel like a genius. Your ego will inflate. You will think you can do no wrong. That is the moment of maximum danger. That is when you will be tempted to use leverage to borrow money against your house to buy more. Do not do it. When the mania hits, your job is to be the adult in the room. Keep your head. Stick to the plan. Do not get greedy at the top. You bought at the bottom, you have already won. Your job now is just to land the plane safely. Also, prepare for the volatility. In a mania, silver can drop 20% in a day and still be in an uptrend. If you're leveraged, you die. If you're physical, you just blink. Stay unleveraged. Stay physical. Stay sane. So here's your checklist for the market open tomorrow. 1. Watch the Globex open tonight. Does it gap up? If yes, the demand is immediate. If it gaps down, it is a final trap. 2. Watch the volume on Friday morning. We want to see high volume. We want to see the pension funds stepping in. If the price rises on low volume, be suspicious. If the price rises on massive volume, it is the real deal. 3. Watch the dealers. Do the sold out signs disappear, or do they stay up? If dealers are still sold out next week, the squeeze is going vertical. 4. Watch the media. Are they ignoring it? Good. We're early. Are they screaming about it? Be careful. We are getting popular. So, here's the verdict. 2025 was the warm-up. 2026 is the main event. We have the perfect storm. Industrial scarcity, monetary collapse, geopolitical conflict. Institutional FOMO. There is no force on earth strong enough to stop this trend. The banks tried. They failed. The governments tried. They failed. Now, the market takes over. You have done the work. You have prepared. Now all you have to do is watch. This is the year you have been waiting for. This is the year silver reclaims its throne. Happy New Year. Keep stacking. And I will see you on the other side of the open. Subscribe.